Hey folks, it's Jeremy Whaley here, and unless you have been living under a rock, you know that 2022, pretty much the whole year, we've been in a bear market. Now the question is, how much is left? Is it possible to know when we're coming to the end of it? Is it possible to kind of get an idea for some of that? And the answer is maybe found in this video, because we're going to talk about the 9 stages of a bear market. And as you look at these stages, you can decide if we've met the criteria and how much longer you might think that we have to go. So let's go take a look at it. Here we go. Hello, everybody. It is Jeremy Whaley here from Trade Maestro. You can check us out over at trademaestro.com. And as I said in the opening, we're in the middle of 2022. There's a bear market that is roaring. It has been roaring all year. And depending on where you're invested, most of you are down somewhere between 20 and 30, maybe 40% or more with your equity accounts. So the question is, how much more pain is there? And then ultimately, what can you do about that pain? And I'm going to talk about 9 stages of a bear market in this video as laid out by Michael Sincere over at MarketWatch. So I think you're going to find this really interesting. Before we get there, just in case you don't make it to the end, I want to share with you one immediate solution that you can do, and that is to go over to my website over at trademaestro.com and join me next week. I have got a 3-day challenge going on, Bear Market Survivor. It's a 3-day challenge, and I'm going to teach you what to do in this bear market. It's not too late, even though you've maybe already lost some substantial money. Day 1, we're going to talk about the truth about bear markets. A lot of people think bear markets have to be bad. They don't. I'm going to share that with you. Then we're going to talk about what to do right now with your money, and then we're going to talk about how to thrive in the bear market. So if you are alive and you're invested in the market and you're looking at your portfolio, you're looking at everything that's going on, and you're thinking to yourself, I don't like this, I'd like something to be different, well, check out the Bear Market Survivor over at trademaestro.com. And you need to get registered for it so I can send you the emails for the links. We are doing it live at noon Eastern time. But if you miss the live event, then we're still going to have the recordings, so you're going to want that. And like I say, it's free, so it doesn't cost you anything. And you're going to want to check that out. All right, let's talk about the 9 phases of the bear market. And this is laid out by a man that I do not know. His name is Michael Sincere. He writes at MarketWatch. He's written a couple books as well. And one of my students, Richard Mish, sent this to me, and I thought it was interesting, so I thought I would do a little video on it and kind of break it down for you. So this was published this week, October 22nd. Actually, it was first published October 18th, it looks like, 2022. And I'll try to remember to put the link in the video below so you can click on that and actually go to the post itself. So the headline is, stocks have been rallying, but the 9 painful stages of this bear market are not even halfway done. Well, what are those 9 stages, and are they even real? So let's dig into it. We'll go our way down here. Kind of a cool little image. I like that. The cow being unzipped and the bear popping his head out. I wish I could do really cool Photoshop. All right. Right here, we're just going to hit the highlights here. He calls these stages, and personally, I don't think they're stages, but you can decide what you think. I think these are characteristics. That would be the term I would have used, but we'll break it down. You can decide. So the first characteristic, first stage, is the failed rallies, and then he breaks this down and talks about how failed rallies represent the first clue. The bear market is here. Duh. Failed rallies often appear before the market officially becomes a bear market, and on and on. So he talks about failed rallies. So let's come over to our chart and let's look at this and break this down a little bit. Do we have a bunch of failed rallies? And of course the answer is yeah. Have you been living under a rock? What is a failed rally? Well, every time the market makes a higher high, you've got a rally. And then this first one that happened actually in January, this is the S&P, nope, sorry, this is the NASDAQ we're looking at. This first one you see that happened in January, well, that is lower than the previous high. So if I were to draw a line from these 2 rallies, these 2 peaks, you would see that it's a lower line. That is a failed rally. It was unable to push to a higher high. This is the first sign of a bear market. So he calls it a phase. This is the first sign, no matter how you twist it, characteristic, first sign, whatever. anytime you have a series of lower highs, and I define them as lower lows and lower highs. So this was a low here, and then our next low is a lower low, and the next low is a lower low. Anytime you have a pattern of lower lows and lower highs, you have, by definition, a bear trend. Okay? So this bear market has been identifiable since, well, really since January, when we had our first lower high coming off the November highs, and our first lower lows that were coming in here, okay? And that was in the NASDAQ. The Dow took a slightly different path, but all very similar here. So yes, by definition, we're in the market of lower lows and lower highs. And yeah, we've been doing that consistently. That is a bear trend, folks. If I drew a line down here, that is a bearish channel. So yeah, bear market, check. Okay, let's come back to Michael Sincere. Let's see what he's got to say here. And the second thing is he says low volume rallies. Another bear market clue is that stocks move higher on low volume. And, well, let me clarify that. They move higher, but with low volume. I didn't read that very well. Stocks move higher on low volume. This is a clue that major financial institutions are not buying, although algorithms and hedge funds might be. It's easy for the algos to push the price higher in a low volume environment. One of the reasons for monster rallies that go nowhere the following day. Okay, so we're gonna look at that one because that one's kind of interesting here. It is a true characteristic. We all know this is a characteristic of bear markets. I do not have volume data for the NASDAQ here, so let's just come over to the Dow. And what you're going to notice here is if let's come to the January rally. This was actually slightly higher high that we had in January. But if you look at this wave of rally that I just kind of highlighted here, let me take this full screen. And if you come down to the volume that corresponds with that, it's lower volume. It's declining volume. And then if you go to each of these bull rallies and you go straight down and you look at the volume, wow. Isn't that telling? These bull rallies have lower volume than the bear sell-off that preceded it, okay? Now, the summer was an interesting time. This was a big bull rally, big rally in the bear market. It was a bullish move. And you can see the volume really was relatively low compared to all the bearish moves. The one that's kind of the interesting outlier is this most recent one. And I want to talk about that. I want to actually zoom in and talk about that for a brief moment here. If we can scoot this over, zoom in. And what you're going to notice is we have some very interesting volume patterns happening here. During the bearish swing here, volume did continue to increase. And as the bulls kicked in right in there, volume decreased. It's been relatively flat, but what has been a strange outlier are these two trading sessions right here. And on those two sessions, big bullish days, we had a volume increase. Very strange. So if there is a reason to think that we could be putting a bottom in, that's an optimistic reason. However, if you saw my market update for this week, you know that I talked about the nefarious plunge protection team. And one of the things that they do is they intervene to prop up stock prices, including with banks, to rig the market. Oops, busted. All right, so that is actually government intervention. It is my belief that the volume increase that we've seen the last couple of weeks here, it's only been on 2 days, only 2 trading session days that we've had it. Both of them very bullish days that made no sense. We had an increase in volume. I think there's manipulation going on in those 2 days. Everything else of the last year has matched this criteria that Michael Sincere is talking about. So yeah, I just find that kind of interesting. All right, let's go over back to the article here. Terrible looking charts. This is the third characteristic. Terrible looking charts. That's a phase, right? No, it's not a phase. The easiest way to identify a bear market is by looking at a stock chart. It goes without saying that the charts look dreadful, both the daily and the weekly. While rallies help to relieve some pressure, they typically don't last. Well, hello, Captain Obvious. All right, let's come over here. Look at the chart. Yeah, it looks bad. Okay, that's all there is to it. It looks bad. Here, let's zoom out, see if it looks any better. Nope, that looks bad. It is bad. It is bad, folks. A 20% sell-off is not good. period. I don't care how you twist it. So yeah, it's bad. And just in case you missed the memo, we told you it was going to get bad last November and December when we started to identify these bearish reversal signals. Something we call bearish divergence right there. We knew this was going to get bad. We were able to identify it before these phases have rolled out. But here we are. We're about 9 months into it, 9 or 10 months, depending on how you choose to count the top. And the bear market is roaring. Okay, so just taking a look at that there. A little bit of a reality check. All right, the next one that we're going to look at, symptom 3 is terrible looking charts. Number 4, strong sell-offs. Have we had strong sell-offs? Yeah. It's been a couple years since the markets have experienced extremely strong selling, but that record was broken the week of September 26th when the S&P hit a new low for 2022. These strong sell-offs are typical of bear markets, followed by rallies that don't last. Ah, there it is. The rallies that don't last. It's a roller coaster that so far has played out during October, okay? Well, he would be right on that. Rallies that don't last. Remember, what was the first criteria? Lower highs? Well, lower highs are made by rallies that cannot sustain. Okay, so clearly we're still in this bear market. Everything's roaring along. Next, and I think this is where it kind of gets a little bit interesting, and this is the part that I really wanted to share. Number 5, mutual fund redemptions. During this stage, after looking at their quarterly and monthly statements, horrified investors throw in the towel and they sell their mutual funds. Also, some investors refuse to look at those reports. As a result, mutual fund companies are forced to sell, which negatively affects the stock market. Typically, when the indexes fall more than 20%, that's where we are right now in the Dow, mutual fund redemptions increase. Okay, this one is interesting. This one is very interesting because we have not seen big institutional selling yet. It's coming. This is actually a phase, and I'm going to talk about Dow phases in just a minute, but this is actually a phase of bear markets where we get to the panic selling, and we've not gotten there. To the contrary, what you're seeing is, what I'm seeing reported to me at least, is I have a lot of clients who are saying that their financial planners, their money managers are telling them buy, buy, buy. And so what you're seeing is you're kind of seeing the fund managers front running this panic, saying, what can we do to keep people in the market rather than closing their positions? And so we're about to see that, I believe. That is a phase that has not kicked in fully yet. All right, the next one, and this is a big one. Number 6, complacency turns to panic. We have not seen the panic selling yet. I thought it was going to hit in May. It did not kick in. I really thought it was going to hit in September and October. It started to. It may still. So we're very, very close to hitting the panic button. As more investor money leaves the market, many investors panic. Most bullish investors are holding on for dear life, but are buying fewer stocks. The most nervous investors sell to avoid risking their precious gains. Okay, let me come to the chart and show you where we are on this. We are at a precarious location in the chart. You say, how precarious could it be? Pretty dang precarious. Okay? If you go back in time to the bull market that ended in 2020, before COVID, this was the biggest bull market really ever. 29,000 is what we peaked out at here. 2020 COVID happened. Okay? The market sold off to, like 30, 40% here. Let's get the exact number here so I'm not making this up, because we went from 29,000 to, I think it was at 18. Yeah, right around 18,000 that we sold off to, okay? So we sold off 29 to 18, roughly that's 30%, right? People were in a panic. We recovered all that. It took about a year, but we recovered all that. All of this move, and I'm going to change pen colors so you see this. All of this move is what I call the inflated move. It's part of the bubble. And that is the gains post-COVID. Okay, for people who bought and held through the entire move. They bought and held up to March 2020. COVID bottom fell out. It recovered by the end of the year. These are all post-COVID gains. You get that? Where are we at right now, folks? Same spot, 29,000. If this level gets breached to the downside, that's when you will see the panic. Now, why is the panic going to come in there? Because it's trading psychology. You have to understand the psychology of the investor, of the trader. We just finally broke even. We had a gain. COVID destroyed everything, comes back. We've got a gain. Everybody's feeling pretty good, like the equity markets are going to reward them. Now we've given all that back, and we're back below 2020 highs. See what happened? We wipe out 3 years of trading gains. It's essentially what happens. So for people who are buy and hold investors, you're wiping it all out, and now we're going all the way back. We're back to 2020, 2019, 2018 levels. That creates panic. Okay, that starts to become more than a 6-month bear market. It starts to look like, oh my gosh, we're undoing half a decade. And then eventually you get into we're undoing a decade. That's why the panic picks up so intensely here. We are at that level. We're getting very, very close to seeing that panic fully kick in. Okay, and the next thing that we're going to talk about here, so complacency turns to panic. Number 7, all the news is bad. It's all bad. Well, I feel like it's all bad anyway. As the bear market pushes the stock market lower, it seems as if most economic data and financial news is negative. I feel like we're already there, personally. Many people become skeptical of the bullish predictions from the market professionals, as if they deserve to be called professionals, who earlier had promised the market would keep going up. In the depths of the worst bear market, some bullish professionals are jeered or ignored. Even die-hard bulls are increasingly nervous as the market heads lower and lower with occasional rallies along the way. All right, so this is very symptomatic of bear markets. All the news gets bad. I feel like we're there. We'll talk about some of that here in just a moment. Let's move on down. Number 8, the bulls throw in the towel. Okay, so whenever you look at the market, and let's come back over here. When you look at the market and you say, how is it staying as high as it is? Why is it still at 29,000, 30,000? Why hasn't the bottom dropped out yet? And the answer is because there's still bullish investors who are holding on for dear life, or as we like to say, hodling. They're holding on. They're saying, I'm going to ride the storm no matter what. Once we start breaching those critical levels, 29,000, that's what it is on the Dow. Once we start breaching those levels, you're going to see those bulls that have been holding on giving up. Okay, so massive shift in sentiment. That's what you're going to see here. That's what he's talking about here. The bulls throwing the towel as trading volume increases in the down days. Some investors experience 30% or higher losses. We're already seeing that. They give up hope, start selling. The market turns into a free-for-all as even the Fed appears to have lost control. What are we seeing right now? What we're seeing right now is the Federal Reserve pretending that they still have control, which they don't. They never did, really. But as the Fed loses control, you're going to see panic really kicking in. Many in the media start to admit the bear market has arrived. We're kind of starting to see that. And then finally, symptom number 9, capitulation. After weeks and months of sell-off, occasional rallies, many investors are panicked. Investors realize it may take years before their portfolio will return to even break even. Some stocks will never get back to break even. We're seeing that now. In the final stages of a bear market, trading volume is more than 3 times higher than normal. We have not seen that. Even some true believers liquidate positions as many portfolios are down 40, 50% or more. Almost every financial asset has fallen, with the exception of fixed income such as CDs and T-bills. Traders and investors who trade on margin feel the most pain. All right, let's break that down. What he's written here is 100% true. There we go. Couldn't get my pen to erase there. What he's written here is completely true. This is the last phase of the panic selling. The best example of this, if you can see this on the chart, and I hope you can, is COVID-19 in 2020. Can you see how high the bearish volume was at the end. It's huge, okay? In market exhaustions, you see huge volume, okay? So we've not seen that kind of volume. If you can see it here, that was the peaks that you were seeing on the volume as opposed to like down here, okay? Much, much higher volume. We have not gotten there yet. We've had increased volume on bearish swings, but we've not seen that kind of panic volume. Let me come back and I'm going to show you a couple of others. In fact, just to try to make this a little bit easier to see, because I hope you can see it. I don't know if you can or not, but I'm having a hard time seeing it on the little monitor that I have here, so I'm afraid that you can't see it. So I'm going to make the volume really bright so you can really see it. There we go. See that? All right. Notice in 2018, this market top that we had right here, look how high the volume was. Same volume levels as what we saw in 2020 for the sell-off. That's what we call a blow-off or an exhaustion. And at extreme market highs and extreme market lows, you have extreme market volume. Okay, so those are some examples there. Let me come back in time a little bit, and we're going to find a couple more. If I can get there, see if I can speed this up. 2008 and 2009. Okay, let me show you this. This was the bear market of 2008 and 2009. I have done a lot of videos comparing these two time frames. Let me kind of adjust this scale so it's really, really obvious to us all here. Make it bigger. There, I think you can see that better. Okay, there we go. All right, notice the first part of 2008, we were in a bearish channel. That is exactly what we are doing right now. Notice the volume during this bearish channel. It was very kind of, you had some spikes, but it was kind of moderate until we got to the end. Look at the increase of volume. It's a doubling of the volume even compared to the bear market that we've already been through. So that is something we have not seen yet. That's the panic selling. That's what we're going to see, I do believe, coming up in the fairly near future here. It's hard to say exactly when that's going to happen, but I do believe that is what's on its way. So if I can rescale this again, I know I'm going through a lot of scaling here. If I can rescale this again, we're essentially right now in the first phase of this bear market. If we were really honest about phases, there's your bearish channel. Okay, and you notice that volume has increased on the selling, it has decreased on the buying, just like he talked about. But all things considered, volume has been relatively normal. I expect we're going to have some more bearishness here, and we're going to see volume days that are like double and triple what we've been seeing. Big, big volume down here, okay? So that's what he's talking about there. All right, what do you guys think? 9 phases of a bear market, is it real? I don't know, pretty good. I have a couple extra thoughts I want to share if I have time in my video. We're already sitting at 23 minutes, but I'll just recap these for you really fast here if you can't see them. Failed rallies, low volume rallies, terrible looking charts, strong sell-offs, mutual fund redemptions, complacency turns to panic, all news is bad, bulls throwing the towel. I don't really think these are phases. These are characteristics in my opinion, but there are some phases that he talks about. He just kind of laid them out a little goofy, but mutual fund redemptions, that is going to be a phase that we will get to. We haven't gotten there yet. Complacency turning to panic. We really haven't gotten there yet. All the news is bad. We're there, but the news isn't reporting it that way. So let me share the way that I look at bear markets, and I think about phases of a bear market. Because this is a little bit different than what Michael Sincere spelled out for you. And I base this on Dow theory. And essentially, Charles Dow identified that there's 3 phases of a trend, and we can take this into both bullish trends and bearish trends. The first phase is what he calls an accumulation phase. And you notice how I drew this kind of like a zigzag here. This is accumulation. Okay? And what's happening in an accumulation phase is the informed investors are buying new positions. They're taking on, they're accumulating new positions. Who are the informed investors? Well, it could be the Warren Buffetts of the world. It could be insiders, and it can just be simply really good, educated traders who recognize that the market is building creating a base here, and it's a good time to be buying. So the informed trader is basically just the person who has additional insight. They're more informed. They start taking on new positions, accumulating new positions. Next, what will happen is eventually this phase breaks out into what we call a public participation phase. And I'll write that up here, public participation, okay? In the public participation phase of the trend, what happens is the public, who's been sitting on the sideline, fearful to get involved, has been watching the accumulation. They finally see the trend is moving and they start jumping in. And the more educated people will jump in earlier. The less educated people will jump in really late, often jumping in at the very top of the trend rather than at the beginning where they should have jumped in. Okay, that public participation phase has all the volume to drive the market. And here's something that you really need to understand about market manipulation. I've said this for years, and you see it playing out right now. Hedge funds, institutional money has enough funds available to manipulate the structure of the market. Okay, they can throw a bunch of money at it, try to create some buying behavior. They can throw a bunch of money at it, create a bunch of selling. They don't have enough funds to drive it from point A to point B. In order to get the market to move from point A, which I will identify with an A here, okay? In order to get it to move from point A to point B in the trend, you have to have the money of the public. You have to have that kind of funds flooding in. Then when we get to the top, what's going to happen is another sideways move that we call a distribution period, okay? Now, what's interesting in the distribution period is the very same people who started the move down here in the accumulation, they start closing their trades and taking their profits. Now, you got to understand that in and of itself is not market manipulation. That's just phases of a trend. So the first part is the informed traders are taking on new positions. The public comes in, second phase. Public comes in, drives it to new heights. And then you get to the distribution phase. The very people who started the move start taking their profits. They're distributing their profits out, basically, okay? The people who are buying at the top are the uneducated traders. And I hate to use that term, but it's the people who, if you yourself or somebody who says, every time I get in the market, it always turns around and goes against me, because you're on the wrong side of the trade. You got to learn how to be on the right side of the trade, okay? So you are, unfortunately, if that describes you, you've been the uneducated trader who is buying from the informed trader who is selling at the top, essentially, okay? Then we get into the bear market. Now, the distribution phase is interesting because the distribution phase can take the shape of distribution rolling over to a bear market, or it can evolve into a reaccumulation phase where investors start to take on new positions again. It didn't roll over, and we end up trading higher. So the distribution phase is kind of interesting. It can take on multiple roles here, but in terms of trend reversals, in terms of phases of the trend, when the distribution phase gets to a accelerated point and it starts dropping below our support levels here, okay, these critical levels, when we start dropping below that, you will have a new public participation that evolves into a panic. Okay, I'll abbreviate this PP, that's for public participation. Okay, don't laugh, you immature traders, you. It's not PP, it's public participation. All right, that will evolve into a panic, and eventually what happens at the bottom, when everything is the most bearish, when people are freaking out, you end up with a new accumulation period. There's your phases of the trend, okay? So the three phases of the trend are accumulation, public participation, distribution. The fourth phase that Charles Dow doesn't talk about is the public participation on the downside. And then that leads right back into a new reaccumulation or a new accumulation period. Okay. Now, there's other characteristics that Charles Dow identified hundreds of years, not hundreds, but 100 plus years ago, late 1800s, that correlate. And this is interesting because it correlates a lot with the 9 phases or 9 phases that Michael Sincere spelled out. One of those characteristics at the accumulation phase, the news is the most bearish. What did Michael Sincere say? He said the news is going to be really, really bearish. Seemed like there's nothing but bad news. Well, that really bad news tips the public participation into panic, and then it really gets established at the bottom of the market. This is an interesting characteristic of market behavior that you're going to have to get comfortable with if you're not already. At market tops, when you should be selling, when the distribution period is kicking in, that's when the news is actually the most bullish. At the market top, whenever people should be taking profits, the news media is just doubling down on how great the economy is, how great the media is. Another thing that happens at market tops is the Federal Reserve inevitably starts raising rates. What do you see happening right now? Federal Reserve is raising rates. They do this at economic cycle tops, okay? We get to the bottom throughout the bearish public participation. The news media will continue to be relatively optimistic, and that's what you're experiencing right now. We are in the middle right now of the bearish public participation. We have not hit the panic phase yet, okay? When we hit the panic phase, the news media will give up. It's everything that Michael Sincere talked about. The news media will give up. Everybody finally throws in the towel. Bulls capitulate. They're like, okay, I give up. That's when the panic hits. That will be relatively short-lived, probably a month or less. You'll see the panic selling. That will be done. I personally believe we'll see Dow 18,000. I've said that for a year plus, okay? Once that is done, the news media will be completely bearish. That's when this accumulation period will start to shape up. That's when you need to actually be looking at buying. That's when we'll start to reaccumulate new positions and prepare for the next phase of the bull market, okay? So we're probably about halfway through the bear market right now. I expect we'll see the panic selling. That's when we can start looking at new accumulation periods. On the opposite side, when the public participation is bullish, the news media is very cautious. So they're basically contrary. Whatever the market's doing, the news is going to be a little bit contrarian to it. They'll be a little bit off. And then about halfway up the public participation phase, the news media will start to be pretty optimistic. And then you get back to the top of the market, news media will be very, very bullish, and everybody's finally jumping in. And that's about the time that the informed investors start closing out their positions. All right, so now you understand the phases of the bear market better. You understand the phases of the trend. And I will, just to kind of wrap this up, I'll put the Dow charts back up here. And I'm going to zoom out a little bit. What do I think is going to happen? I expect this right here. This is part of the public participation. The distribution was up in here. That was the distribution phase. Okay, we are in a bearish public participation. I expect we're going to have panic selling at some point into the end of the year, beginning of 2023. And I think we'll wrap up around 18,000, which will actually be in line with COVID-19 panic of 2020. Well, that's confusing. I think we'll actually kind of match those lows, and that's probably where we'll have the chance to start accumulating new positions. That's my hypothesis. That's my theory at this point. I'm not saying that we retrace 100% of that wave. Well, I am. What you got to recognize is we're actually retracing for a much bigger wave, like the one that goes all the way back essentially to 2009. So that's why I think we're going to see a lot bigger selling than we're seeing right now. And a lot of people are going to panic, but you don't need to panic because now you know. Now you know what's going on. Now you know what to expect. The question is not, should I panic? The question is, how do I prepare for it? How do I behave through this? So there's a lot of options. The best thing that you can do right now, if you've not already positioned yourself, the best thing you can do is sign up for free for my Bear Market Survivor course, which is a 3-day challenge. About 90-minute sessions, 60 to 90 minutes, 3 days coming up next week. Depending on when you watch this video, if you start watching this video middle of next week, well, you might just have to watch the recordings, and that's okay too, because the content is going to be exactly the same. It's a recording of the live session, which we're going to do Monday, Tuesday, and Wednesday. And again, if you missed that, then no big deal, just watch the recordings. But to take advantage of that, all you need to do is go over to trademaestro.com and click on Join the Challenge, and then you'll get added to the list, and you can participate. All right. That's it, folks. I hope this has been helpful for you. 9 phases of the bear trend, bear market. Then I mixed that up with the Dow phases, kind of gave you my feedback on that. If you've not signed up for the Bear Market Survivor Challenge, you should do that right now. If you've not subscribed to this channel, you should do that right now as well, because I got a lot of really valuable stuff that's going to be coming out this week. The Bear Market Survivor Challenge just being the least of which. I also have some other stuff coming up as well. So you're going to want to get subscribed so you get all the notifications for that. All right. I hope you guys have learned a lot from this. I hope you got some questions answered and you got some ideas of what to do in the future. And that's all I got for you. So until next time, happy trading to all of you. We'll talk to you soon.